for joining today's webinar. We're excited to have you guys. So as we start letting you guys join in on the webinar, we're going to go over some housekeeping rules, a little thing Quest Trust Company has going on. Again, my name is Juan Deshawn. I'm one of the IRA specialists here at Quest Trust Company. If you've called, then you may have spoken to myself or my team. Today, we have an exciting topic for you guys that through my personal connections and phone calls, I actually met Greg, which is Tim's brother, that works for Cityside Capital. And in discussing what they do, it's very, very interesting and I think very useful for a lot of people, all of our clients of ours, and just investors that we have within our network. So I'm glad you guys are joining. And again, just going over some housekeeping rules as we join today's webinar. So if this is your first time, I really thank you guys for joining. Quest Trust Company is a leading self-directed IRA custodian located out of Texas. I'm currently here in Houston, but we have offices in Austin and in Dallas. We administrate over $2 billion in assets now. So we see a lot of different investments pop up through the Quest Trust Company. We hold a lot of undirected cash. What does that mean? That means that people are not using all of their funds within retirement accounts and looking for investments. So on that note, I will add my disclaimer. We're not here to tell you what to do, but more so educate and kind of provide you with as much information and knowledge as possible for you to make the best decision. Right. A little bit of what you can do to, if you're a client of ours, deploy funds, find opportunities, learn more, is take a look at these squares here. We have weekly classes. This is an example of one, right? This is at 12 p.m. on every Tuesday. We have one on 12 p.m. Central Time on Saturday. We have virtual networking happy hours, which is essentially a platform where anyone can join, pitch an investment or listen to investments being pitched, or even services, so people can communicate and network and kind of just connect online. And you can rewatch everything that you're about to watch now and more on our YouTube channel and our Facebook. So please subscribe to our YouTube channel. We have different kind of segments. We have these classes that you can rewatch and much, much more. The upcoming events in person, if you are local to one of our offices, Houston, Austin, or Dallas, our socials happen on the 1st, 2nd, and 3rd Tuesday of the month. So if you're looking to meet people in person, shake some hands, please come out to our socials. We kind of do the same thing we're doing online, but in person. We're trying to get back to that after COVID. Things went fully online, but now we're going back to in person and enjoying that just person-to-person networking. For those of you who may not be clients of ours, we are having a month-long promotion going on for any individual that has a reason to have multiple IRA accounts, whether it's for you and your family, or you have multiple types of plans, traditional Roth, SEP, simples, you name it. We are not going to be charging you per account you open, but more just one for everything you need, right? So please call us, ask us about our promotion, Multiples 22. If you are an interested client, or you even right now opening an account and maybe want another one, just know that one will be completely free. So that is the rest of the month. So take advantage of that, Multiples 22. Two events I want to show everyone, and then we'll get to the meetup presentation. I think these are helpful for you guys. So live after 5 happy hour in San Antonio. So we know we have an office in Austin, but there are a lot of clients of ours in San Antonio. So if you're listening and you are in San Antonio or network in that area, come out to Little Woodrow's on August 25th and come network with us, right? So we're going to have just more in-person events, trying to branch out of our main cities and also host events in nearby places where we know a lot of activity is happening with you guys. And our biggest event, our Quest Expo. So if you go to conferences throughout the year, I know I do, Tim, you might, and I meet all my connections through these conferences, business to business connections, client connections, or even personal investment connections. And so what we do is through these individuals that we meet going across the country, we try to bring them to one area, which is our Quest Expo. So we share our network with you. We have speakers going live for 2.5 days straight of education and content for you guys to learn, and over 50 service providers or investment individuals that can give you guys opportunities to find deals for your retirement funds or even for your personal funds and services. So our Quest Expo is kind of an alternative investment exposition where you can go ahead and network with a lot of our clients, a lot of investors in the local area and cross country, right? And of course, the speakers that we're bringing in are coming from everywhere, right? So scan that QR code, go ahead and get yourself a ticket. That is in September of this year. So we're pretty excited that we're just 2 months or so out of this big event. This is a hundreds of people event, right? 500 plus people attend this event. So definitely check it out. And our big celebrity speaker is Emmett Smith. So he's a real estate investor. So he has a pretty interesting story. Great speaker. He'll be there shaking some hands as well. But without further ado, if you guys have any questions afterwards, we're going to do questions at the end of the presentation for Tim. If you guys have questions for anyone, myself or my team, you can use any of these resources, our number, our chat, our email, or scan the QR code to have a one-on-one consultation over the phone, right? But that's what I have for you guys today. Tim, I'm going to let you go ahead and bring up your screens. And while we do, I'm going to talk a little about Cityside Capital and kind of what you will be presenting today. And of course, you'll add more information than I can. But guys, I think this is very useful for you. They deal with syndications, which is what a lot of my clients deal with through IRA accounts. It's a very, very popular asset, but they're a little different. I think I'm going to add value to those of you who are not only investing through IRAs, but also investing just personal funds, because there's a little bit that he's going to talk about that many people have a misconception of, and that's the fact that you can 1031 towards syndications. And so, Tim, I'll let you take the stage.
Awesome. Guys, thank you so much for the opportunity to come on the show today. I'm really, grateful for the opportunity. So, hello to everybody out there. My name is Tim Lyons. I'm the managing principal of Cityside Capital, which is a small private equity firm. We are registered representatives of a broker-dealer. What does that mean? That sounds crazy, right? So we raise capital, both retail investor capital, 1031 exchange capital, and also retirement account capital from everyday investors who want to have exposure to real estate, but they don't want to do it in an active form. They would like to be passive investors. A lot of people just don't know that you can use your retirement accounts, solo 401ks, self-directeds, to get into real estate like this. So it's a very powerful tool. And, my brother and I have Cityside Capital, and we're just passionate about spreading the word. So today I kind of wanted to take a few moments to go over, what is syndication? What is a passive investor? How does it work? How can I get involved? And then also I wanted to also talk about a really powerful tool called the 1031 exchange. The 1031 exchange is talked about a lot, whether you're a podcast listener, YouTube video watcher, conference goer. But there's a lot of misconceptions. There's a lot of rules to it, a lot of, hard and fast deadlines, and, what you can and cannot, use your net proceeds from one sale, and how do you roll it into the next one and do so in a timely manner and dot all your I's and cross all your T's. So we're going to go over that a little bit. And feel free to drop any questions you may have into the chat box, and the fellows over at Quest will facilitate that. But we'll probably do a little Q&A at the end of the show. All right, I'm going to go ahead and share my screen. All right. So if one of you guys could just shout out and tell me if you can see my presentation screen, and then I'll get started.
Yeah, we're all good. I see it perfectly.
We are all good. So you're wondering, why is Tim sitting on a fire truck if he's in a private equity firm? Well, the truth of the matter is I'm a New York City fire lieutenant. I've been a New York City firefighter for 17 years, this past May, on my way to my 20-year retirement, where I can focus on this full time. So I work in a firehouse in Queens, and it is a great, great job, and I love it, and I love everybody I work with, and it allowed me to pursue my passion in real estate. So that's just me. So here we go. So, a lot of times people are very, very reluctant to try real estate, right? This is what I talk about on my podcast all the time is investors, I should say, let me try day trading, options. Let me try crypto. Let me try fix and flips. Let me try single family homes, being a landlord. And they do all these things. But real estate tends to be last because it's scary. And everybody has an Uncle Joe that didn't make out on a property, and it kind of spoils the real estate route for a lot of people. And depending on where you live, right? I grew up in the greater New York City area. And cash flow is really hard to come by, right? The prices have always been sky high. So real estate really wasn't on my radar for a long time until I kind of really got the bug and I got educated. I surrounded myself with the folks that are doing the thing that I wanted to do and got myself in the right rooms with the right education and took action. And ultimately, that has led my brother and I to being general partners in over $700 million of commercial real estate assets, mostly in multifamily, but we also own some self-storage as well. So that's crazy. It's a crazy story, crazy trajectory in just 2.5 short years. So my whole point to that is, you can do it too. And if you have assets, stuck in your self-directed IRAs or solo 401ks, just know there's other options out there besides just equities, stocks, bonds, and mutual funds. As a full disclaimer, since I'm a registered representative of a broker dealer, I am not giving any advice on what you should actually do today. I'm just kind of throwing this out there as an education of what's possible. And I'd love to hop on a call separately or answer any questions that you might have after this is done. So I kind of included the slide, but nobody really cares, right? I went to college, became a firefighter and an ER nurse for 9 years. I got stuck in the W-2 grind. I needed to get into real estate or buy a business. That's how I got here. Now we've done north of 13 deals worth over, this is an old stat, we have to change that, but over 700 million and probably closer to 5,000 doors. So why do we even talk about this, right? Why is real estate so powerful? And I think I think each of us knows deep down that we should probably be in real estate, but we don't know how to get started. We don't know who to trust. How do you underwrite a deal? How do you know what market is good? What are the metrics I should be looking at? Why is real estate so powerful? And I wanted to start off with, the 5 different ways that real estate can pay you. The first way is what we all kind of know about is cash flow, right? There's a lot of different ways to skin a cat in real estate, but most people will say you have to buy for cash flow, right? And what does that mean? That means every month when the renters pay their rent, you have your rental income minus expenses, capital expenses or capital expenditures. What is your vacancy that you underwrite for, and repairs and maintenance? So when you have the rent come in and you have all your expenses go out, what's left over is your cash flow. So that's the first way. The second way is appreciation, right? We all understand that, especially with the tailwinds that the market has seen in the last 2.5 years has been insane, right? Not normal, but it's built in, right? Residential 1 to 4 units appreciation is really calculated by the comparable sales in the neighborhood. What is your neighbor's house selling for? And that's pretty much the ballpark of what your house might be worth, right? And you have to always understand it's in the rearview mirror appreciation on residential 1 to 4 unit properties. We're always looking backwards. All right. Multifamily is defined as 5 or more units, and that is totally different in the valuation process. It's really net operating income divided by the prevailing cap rate or capitalization rate in whatever market you are investing in. That sounds complicated, right? So let's break it down. Net operating income is nothing more than your income coming in from the property minus all your expenses, your capex, your vacancy, your repairs and maintenance. That's your net operating income. So it's income before your debt service. Now, what's so powerful is that if you can take a project, 100, 200, 300 units, doesn't really matter. It's all the same fundamentals. If you can increase net operating income by raising rents, providing new amenities, renegotiating contracts with garbage or the water department, electricity, Wi-Fi, there's all different ways where you can add value to a property, and then the dividing it by the prevailing cap rate can really lead to something called forced appreciation. So you can take a business plan where you can have an under rented complex, say by 200 units per unit per month, $200 per unit per month on say 200 units. And just by releasing and renewing the rents to market rent on those 200 units, you can vastly increase the value of a multifamily property. The third one is loan pay down, right? Depending on how the deal is structured. I mean, a lot of deals where we work with, there's interest only loans that we use, and that magnifies cash flow while we're instituting the business plan to increase that NOI. Other business plans actually have a amortization schedule, and the tenants are not only paying the bills, but they're also paying down the loan. So now you can increase your equity with loan pay down. Then we have tax benefits. I'm not a CPA, but I'll tell you this: there's three buckets of income. We have active income from our W-2 jobs and 1099, consulting gigs or work from home type stuff, and that's taxed at your normal. Um, everyday tax rate, whatever tax bracket you fall into, that's bucket number one. Bucket number two is portfolio income. So portfolio income is nothing more than stocks, bonds, crypto, munis, ETFs, mutual funds, and that's taxed at long-term or short-term capital gains. Bucket number three is where is the holy grail, right? And that's called passive income, your passive income bucket. So all income that's derived from rental activities falls into the passive income bucket. The powerful thing about this is when you're investing in cash, your passive income is offset by your passive losses. Well, what are your passive losses? Let's go back to some of the expenses, some of the capex, some of the repairs and maintenance, and the big one I didn't include in here is depreciation and cost segregation. That's a whole other webinar that I could put on about cost segregation and depreciation. So just know that your income when you're investing in cash is tax advantage because the passive losses will offset passive income. Now, if you're investing in a self-directed IRA or a solo 401k or a similar vehicle like that, this slide isn't as advantageous for you. And I would highly recommend that you connect with the guys and gals over at Quest Trust to really dive into, what type of plan will benefit you the most. If you have other self-directed accounts or other, retirement accounts that you're using for something like this, you want to be careful about something called UBIT taxes. And these guys would be great at directing you in the right direction. And then finally, we are in an inflationary environment, right? So you might hear a lot, real estate is a hedge against inflation. And that sounds cool, but what does it really mean? So, look, there's no doubt that if you have $100,000 sitting in a retirement account or in a checking account or savings account, you're losing at present 9.1% of your purchasing power per year. So what does that mean? If you didn't do anything a year from now, right, you would have instead of 100,000, you'd have the purchasing power of say 91,000, or 90,000. So you want to put your money to work. And how does real estate work as an inflation hedge? Well, look, as inflation goes up, if you look at the charts, and I probably should have included it in this presentation, but as inflation rises, so do the prices of assets, stuff like real estate, tangible assets, gold, silver, stuff like that, stocks and bonds. And usually the definition of inflation is there's too many dollars chasing too few goods and services, right? So that excess of liquidity has to land somewhere. So they usually land into hard assets. So not only that, people's incomes tend to rise in an inflationary time too. So now incomes rise, rents tend to rise during inflation. So now you're locked into a loan at a fixed rate debt, hopefully, right? You got good debt on the property. And now you're going to be paying the bank back with inflated dollars, right? And your fixed costs stay where they are, but you can charge more rent, right? So you're staying ahead of the inflation. All right, so what are we going to talk about today? Let's talk about the pros and cons of passively investing in multifamily. What does it even mean to be invested in a syndicated real estate deal? Something you're going to hear a lot about is when you get into the space of passive investing or investing in general, you really want to know, what kind of deal am I looking at? Is it a 506B as in Bravo offering where they can take both accredited and non-accredited folks? Or is it a 506C as in Charlie offering where they can only take accredited investors? Due diligence, right? How do you know who to trust? How do you know what market is good? What are the metrics you use? Who is the operator? How do I know this guy's good or this girl's good? What is their track record, right? How do you know how to underwrite, how to do some due diligence as a passive investor? And finally, 1031 exchanges, super powerful tool for real estate investors. All right. So when we get into real estate, there's two types of investing really when you come to real estate. It is being active or being passive, right? And let's talk about being a passive investor. So if you know your investing goals, right, everybody's time is valuable. I think now more than ever, people really realize that time is really our number one asset, right? So what are some of your goals? Is it to be active or is it to be passive? What's the time frame you're looking at? Is this a short-term thing and you need to be liquid, or this money that you're looking for retirement and you have a big runway and you're not going to need the liquidity as much? And where are you in your financial position, right? Are you accredited? Are you non-accredited? Um, do you have an emergency fund set aside? Where are you? And once you kind of get clear on those investing goals, what my time frame is, and what your financial position is, you can really decide if you want to be active or passive. All right. So some of the pros of being a passive investor is that you don't have any active responsibilities, right? That proverbial 3 a.m. call that you get with the toilet leaking that everybody references when you say, I'm going to invest in real estate. I got to tell you, I haven't gotten one of those calls yet. Well, not at 3 a.m. at least. But yeah, you don't have to worry about, tenants, termites, and toilets, right? And the midnight emergencies. Another pro is that you can really set it and forget it, right? The hardest part of your day when investing passively in some sort of deal, whether it's single families, build to rent, multifamily, self storage, industrial, there's no shortage of ways to get involved. Is, the hardest part of your day is to, underwrite and do your due diligence on the operator and the deal and the market. And then once you set it, you can really kind of forget it and let the cash flow kind of hit your account either every month or every quarter, depending on how the deal is made up. And then once you're invested, a lot of the timelines for these types of deals are 3 to 5 years, could be 3 to 10 years. It's really dependent on the operator and the deal. And then one of the pros is the cash flow, right? You always, whether you're not you always, but I always look for deals in my company that cash flow on day one. And if we can cash flow on day one, then we know we can implement our business plan. And in 18 to 24 months, we can have a stabilized project that we can either refinance or sell, or many different exit options. So a lot of the deals have monthly or quarterly cash flow that gets direct deposited into your account. All right. So what are some of the cons, right? I mean, sounds too good to be true, Tim. Tell me what to look for, right? And in full disclosure, I'm a New Yorker. I'm very skeptical by nature. So for me to even talk about this, is a lot. So all right. So we talked about goals, time frame, financial. If one of these does not align with being a passive investor and you want to be more active or you need liquidity, those are some of the big factors you've got to take into consideration. So lack of liquidity, we just talked about 3 to 5 years or longer. This is not something you can go onto an app on your phone, hit sell, and be liquid within a day or two after the transaction settles. So this is capital that you really want to be intentional about. Where do I want to put it for 3 to 5 years? You don't have any control really, right? So when you're a passive investor, they're not going to call you and say, hey, Tim, we're going to renovate 10 units this month. What color do you want the walls to be? Or do you like this mirror or that mirror? So there's really no control. So you're ceding control to a experienced operator who's done this before. And they take the lead about doing and implementing the business plan. And then if you're not okay playing in the sandbox with others and splitting profits, this may not be for you, right? So if you want to take all the profits and not have to split 70-30 or 80-20, however the deal might be set up, this may not be for you. All right. So we just talked about, active or passive. I'm not going to read all this, but, there's tenants, toilets, and termites that we talk about. Do you want to be active or do you want to be passive? How much time do you want to commit to this? I was a little anecdotal story here. I was a New York City. I am a New York City firefighter. I was an ER nurse for 9 years, working 12-hour shifts, and so I had two jobs. I worked 24-hour shifts in the firehouse, and I worked 12-hour shifts at the hospital. I was always at work. I'm a hard worker. I like to make money, but I also have 3 little girls at home: 11, 8, and 3, and a wonderful wife. So adding real estate onto my plate, that was a lot of time. It became a third job, right? And that wasn't conducive to my lifestyle, to my family. So you really got to get clear. Active investing, there's a lot of time required. Passive investing, if you're a high net worth individual, you make a lot of money, you have a liquidity event, or you have a self-directed and you want to put that money to work, maybe the time aspect puts you into the passive lane. Same thing with involvement. We talked about the profits. Expenses. When you invest, say, 50,000 or 100,000 into a deal, we send you monthly and quarterly financial statements, and you can kind of look over that. But you're not in the driver's seat, so you don't really have to make those, burn any brain cells making decisions about expenses and should we go with that insurance company or this insurance company, or should we get a bid over here or a bid over there, and that's all kind of handled by the professionals that do this thing every single day. And then the risk, Tim, what's the risk and the liability? It's a great question, right? So, $50,000, $100,000 investments. Let's call it 50. You invest $50,000 into a syndication. You're liable only for that $50,000, right? So obviously, every property we have has insurance and has LLC and entity structuring. So you're only liable for that $50,000. So I don't know, some crazy, unforeseen black swan event happens at the property and everybody gets sued. And, well, Tim, what happens then? Can I lose my home? Can I lose my business? And the answer is no, right? You're only liable up to the amount that you invested in. The paperwork. Paperwork for syndications is really easy now, and in the post-COVID era, right? Everybody's very comfortable with DocuSign or a similar product. So we send you a PPM, which is a private placement memorandum that describes the project at length, usually about 100 pages. And then we also have subscription documents where you would sign for how many units you want to purchase, stuff like that. All DocuSign, and then you're done, right? As an active investor, obviously anybody who's active out there knows that the paperwork never stops. Building a team, super huge when investing or just living life or running a business, right? Having the right people in the right seats at the right time. So as an active investor, you got to build your own team, right? As a passive investor, you're going to be sharing in the expertise of the existing team and who they're working with. So you can really leverage the teams that are already in place. Diversification, right? I mean, I think right now people are really in tune with diversification of their portfolio, right? Tons of articles coming out right now on a lot of the mainstream media about the 60-40 stock and bond portfolio of yesteryear that are maybe our parents or aunts and uncles or some of the older folks out there were really kind of brought up on, may not be working the way that it was intended to work, and people are looking for diversification, right? This is really kind of where I talk about if you have $100,000 in your account in stocks and equities and it goes down by 10% one day, well, how much do you have left, right? You have $90,000 left in your capital account. Well, if the next day that same account goes up by 10%, well, now how much do you have, And the answer is obviously 99,000. Well, what happened to the other $1,000 in your capital account? And that's happening every day incrementally in your stock and bond portfolio and your ETFs and your mutual funds. So just being, mindful that, real estate is it's a slow moving asset and it's sticky, right? The rent's going up, the rent's going down. I mean, rents have been crazy, not sustainable, but they're not going to be coming down at the same pace, right? They're more sticky throughout history. And it moves like a barge. Real estate moves like a barge. You can't, just jump in and jump out as you can on your Robinhood app or something similar. And then taxes, right? As a passive investor, you don't need to do any bookkeeping. It's all done for you. The operators and people like myself over at Cityside Capital, we send you a K1 statement every spring for your accountant or accounting team to look at. That shows all the income and losses for the property for the year. So there's really no need to have somebody doing your bookkeeping every single week or month as you would as an active investor. Really quick, what's the process of investing in a real estate syndication? Tim, how do I get started, right? This sounds great. Or I just need to know a little bit more. Well, it usually starts with the sponsor announcing that a deal is open for funding via an email. There'll be a summary deck that you can look at, a webinar, usually pre-recorded. Some people do live webinars, but you'll have like a summary deck with a PDF, a webinar. Some of them will show the underwriting. You would then take a look and review it. If you like what you see, you would submit what's called a soft reserve or a soft commitment. And that's just telling the sponsor that you're interested, you need more time to go through it, but this is the ballpark amount that I'm looking to invest. Usually these deals tend to fill up in the first week or so. So by submitting a soft reserve, what that does, it stops the clock and it kind of gets you your spot on the team for this particular project. But you still need time to review the documents, and make your final decision. But at least we can stop the clock. The sponsor will hold in a webinar where you can get more information. And this is really powerful. This is what I really hope everybody kind of hops onto the live webinar or watches the recorded webinar, because you could really hear the business plan and the story behind the property or properties from the lead sponsor themselves. Which is super powerful. And I think a lot of people's questions get answered because everybody has the same kind of questions. So they know really how to talk to investors on that webinar. Then the sponsor would confirm your spot in the deal by sending you the PPM and the subscription docs via DocuSign. Once you sign those documents, you would have you get wiring instructions with your bank account, routing number, and account number, and the bank name and address. And then you would wire your funds. The sponsor would then confirm that we received your funds. And then we notify you when the deal closes, and then let you know what to expect next. When the distribution is going to start, stuff like that. So now you're in. Now what? Now you wait for the cash flow, right? You may either get monthly or quarterly cash flow distributions. And a lot of times the investors that we work with, the operators, we work with 9, soon to be 10 operators across the US. But a lot of times in the first distribution starts 60 to 90 days after we close. And why is that? Well, we have to come in, implement our systems, implement our teams, our property management software. So it takes a little bit of time to kind of get up and running, and not having that added pressure of just trying to get the cash flow out immediately is something that is, what the operator really kind of needs to get started. But your distributions, they accrue and compound from day one. So even though we don't pay out the first 30 days, you will be caught up. So you get all the cash flow that you're due. Then we do the monthly updates and the quarterly financials. And then at the end of the year, you get a K1 statement for your taxes. And then, after, say we're doing a 5-year hold and maybe year 4 is approaching and maybe we have a chance at an opportunistic sale, you would get an email from us or from the lead sponsor saying, hey, we're about to sell. You have a couple options. Do you want a 1031? We have a new project coming on, the next 2 months, or you can cash out. Just want to go over what an accredited investor and a non-accredited investor are, so people can really dial into what types of deals are available to you. So a lot of the bigger investment opportunities are really open to what's called an accredited investor. There's 3 criteria I'll go over on the next slide. And those are really 506B and 506C deals that can take an unlimited amount of accredited investors. 506B deals are open to non-accredited but sophisticated investors, meaning you got to demonstrate that you really kind of understand what this investment entails, what it's all about, how it works. That's done by conversations with folks like myself or my brother Greg or the lead sponsors. And that's how we could kind of qualify you to be, to be available for some of these opportunities. All right, to be a accredited investor, there's really there's three requirements. You must have a net worth of at least $1 million, not counting the equity in your primary home, and that's huge because this is really part of the wealth effect, right? People tend to feel wealthy when they have a lot of equity in their primary residence. But yes, $1 million net worth, so that's your assets minus your liabilities, being more than $1 million. Or I should say, you personally make $200,000 over the last 2 years, and with the expectation of making the same going forward, or you and your spouse make $300,000 together. And that's gross income, not net income, gross income, for the last 2 years, with the expectation of making the same going forward. There's also some other ways to be accredited, like for example, if you have your Series 7 or your Series 82. Or your series, I believe, is 22, but I have to double check on that. That's another way to be accredited. But Tim, I've always heard that you cannot exchange 1031 exchange into a syndication, which is true. You cannot 1031 exchange out of a single family or some other property into a syndication as an LP with the way I just showed you how to do it. But what you can do, it's a really powerful tool. If you don't know what a 1031 exchange is, in one or two sentences, it is say you sell a property that say you have a property that's worth $500,000. That's what you sell it for, and you owed maybe say you owe nothing on the property. So now instead of paying a capital gain on that 500,000 in profit, you want to do a 1031 exchange. So what you would have to do is let your escrow agent or your attorney know that you want to investigate a 1031 exchange, so that at the closing table they can wire the money to what's called a qualified intermediary. That qualified intermediary is basically an escrow firm that will take possession of the net proceeds from the sale of whatever property that you're relinquishing, because you can't touch it, right? You can't cash a check and say, you know what, Tim, I think I want to 1031 exchange these funds. Doesn't work like that. So once it goes to the escrow account of the qualified intermediary, those are the experts on 1031 exchange. They can answer all your questions because there's about 1 billion ways to do this. But at the end of the day, there's very tight timeline requirements. So once you sell your property, you have 45 days from the sale of your property to identify up to 3 different properties. That's called the identification stage. Once you have the 45-day window pass, then you have 135 days after that to actually close on one or all of those properties. If you miss it by even 1 minute, 1 day, then the covenant is broken, and they will just hand over the net proceeds to you, and then you'll have a taxable liability from the sale of the original property. So these days, it's been hard. What I found in our business starting in about December and January, was that the market was moving too fast, right? So people were trying to cash out and ride the tailwinds of the real estate market up. They wanted to harvest that equity, so they wanted to sell, really capture that gain, and they wanted to 1031 exchange. But what they were finding is that the new properties that they were identifying were going like this, right? There was 20 different cash buyers, no inspections, or inspections for informational purposes only, and we want to close next week. And how do you compete with that, right? I mean, this is 1031 capitals. A lot of times it's significant amounts, right? We just placed 2.4 million into a 300 unit property in Houston, Texas, using this method. But there was a due diligence period, right? We could answer all the questions. And if you're doing it by yourself and you want to do something like that, sometimes these properties are moving too fast and you just don't have the proper due diligence. And the thing you don't want to do is get into a bad deal just because you're up against a deadline. So Greg and I have been getting a ton of calls this year about 1031 exchanges, because people have heard that you can maybe get into syndication. And that's true, basically. So the 1031 exchange is the major tax benefit, right? It allows you to defer the capital gains by exchanging your gain into a like-kind property upon sale, rather than receiving all the sale proceeds in taxable cash. Without getting too deep into the weeds, you can parse out some of that cash if you wanted to. It's called boot. You would be responsible for the taxes on that boot, and you can use the remainder to do a 1031 exchange. You can combine your 1031 exchange with a sponsored investment that does allow 1031 exchanges. And basically you would be becoming a limited partner in a professionally managed, large scale 200, 300, 400 unit property, or a self-storage facility, or an industrial park. There's all different ways that you can do this. Then we do this by doing something called a tenant in common agreement, right? So you're not coming into the syndication as an LP, you're coming in as a separate entity alongside of the syndication, which is called a tenant in common. The powerful part about that is that, say the guy I just told you about with 2.4 million into the Houston 300 unit, when that deal goes full cycle, say in 3 or 4 years, he's now eligible to take that 2.4 million, plus whatever profit he makes, say, call it, I don't know, 4 million. And now he can take that and go to any other property that he wants. He doesn't have to stay with that same investor, that same group that's leading the syndication right now. If you come into that as an LP, a limited partner, and that operator or that sponsor takes a deal full cycle, say 3-4 years, maybe they double your capital or something like that. So your 50,000 now becomes, say, 90,000 or 100,000. Only as an LP can you stay with that same sponsor that may have another deal. If they sell one asset and go into another deal, you can join them as a 1031, but you can't take your 50,000 that now became maybe 100,000 and go to sponsor B and go do their deal. So it's very deal specific. So when you come in as a tenant in common, you have a little bit more flexibility. All right, so you can't do the limited partner route, right? Because technically, as a limited partner, you don't own the physical real estate. You own a partnership interest in the entity that owns the physical real estate. So that's very important when doing a 1031 exchange. So we talked about the tenancy in common structure, which allows the 1031 investor to take direct title to the property, right? Because your tenant in common structure entity, LLC, is coming in right next to the main entity that's taking over the property, right? So you're becoming a title holder as well. Whoop. So the complication of the TIC structure within the management partnership agreement is that the tenants in common, they have joint and several ownerships of the property with equal control. Well, that doesn't bode well for financing, though, right? So the lender wants to know that the sponsor is in control and they have the ability to oversee the success of the deal, right? So the joint venture economics and control rights can be outlined through a side letter or through other means that can make the 1031 fit into the traditional joint venture structure, but really kind of make you a passive investor. And if you're hearing this for the first time, you're probably like, Tim, what the heck are you talking about? So the good thing about this is that we've done this multiple times. We have the attorneys, we have the documents, we've done this, a lot of our operators have done this many, many times. It's seamless for them. So it might sound complicated today, but it's seamless for them. And I'm more than happy to jump on a call or to go over this at the end if anybody has any questions. But in the name of time, just wanted to kind of finish up here. So I had the opportunity to write a chapter in a book. If anybody wants a free copy of that book, I wrote it with Robert Helms. Many people might know he's a real estate developer and syndicator. Just email tim@citysidecap.com. Everybody always asks me, Tim, how do you know so much? Where do you get your information from? These are some of the books. I just wanted people to understand that there's a ton of information out there. How do you filter it? How do you triage, what information I should be, kind of circling as something I should be reading next, or what resources do other people read? So I just wanted to kind of throw this out there, and I can email this out to anybody that wants it. Some of the podcasts that I listened to when I first got started that was really instrumental in getting my education to where it needed to be was Get Rich Education with Keith Weinhold, Bigger Pockets, Whitney Sewell's The Real Estate Syndication Show, Joe Fairless's Best Ever Show, Jake and Gino. The Real Estate CPA is a very powerful show. If you have any kind of questions about taxes and real estate, they are a great, great resource. And obviously, we have our own podcast called the Passive Income Brothers Podcast, so you can check that out as well. So there's a picture of why I do what I do, my 3 little girls, and my beautiful wife. So with that, I will turn it back over to you guys to see if anybody has any specific questions or concerns, or you want me to dive a little deeper into anything.
So Tim, that was very helpful and useful, and I learned a lot. Actually, I didn't know any of that on 1099 side, 1098. But guys, send in your questions if you have any. I put his email there, so thank you for a copy of that book. Do we just email you for a copy of that book, or what?
Yeah, so you can email me. I can send you the physical copy, or if you want the PDF copy, which is obviously instant, I can do that for you guys. And yeah, like my email. This is what I love to do. This is what I love to talk about. You know, and I'm one of those guys. If I don't have the answer, believe me, I'm going to go find a few, and we will close the loop and get you the answer, and connect you with whoever you need to be connected with to make this happen.
Okay, perfect. Yeah, I might email you for a copy of that book. I'd love to add to my bookshelf.
Yeah, absolutely.
And I had a question, but it escaped me. But I do have a question here showing, or they're popping up now from some attendees. So we'll start putting them one by one here on the screen. So how is this different from DST? I'm not sure what DST is, but do you know?
Yeah, so DST is called a Delaware Statutory Trust, and DSTs are, generally speaking, they invest in core plus assets, so A class properties, newer built, lower cash flow, and or triple net lease type of properties, which is all great stuff. The problem is that DSTs, the custodians of the DSTs, it's hard to get on board a little bit to get our projects in front of them, but they're more liquid. And I am not the expert on DSTs, but it's very similar to 1031 exchange and DSTs. So I do have somebody that I refer everybody that wants to do a DST to. So reach out at tim@citysidecap.com and we can hook you up.
Cool. And then Jack wanted to share just thanks for the information. So just putting that on the YouTube channel. Thank you, Jack, for joining. We appreciate it. If you guys have any other kind of content or questions that you guys want to get answered, but of course you just don't want to ask here, Tim, that's his email. Ask for the book, shoot him some questions. He seems like a knowledgeable guy. And I might even ask you some questions sometime whenever it comes up. I always confuse 1031 with 1099, guys, because I deal with 1099s all the time, and I'm just thinking 10 number. But no, I appreciate your time, Tim. Thank you for taking time out of your day during lunch hour. Hope you're not starving. And we'll be glad to have you back soon, and hope to see everybody else at our next webinar on Saturday. So again, thank you guys for your time.
Thank you so much.